The Institute's Griffith Insurance Education Foundation is a 501c3 nonprofit, nonpartisan, and non-advocative educational organization dedicated to the teaching and study of insurance and risk management. In keeping with our mission, the following presentation is strictly instructional in nature and does not take a position on any issues.
Hi, my name is Chuck Nice. Welcome to the Institute's Griffith Foundation Summer Series for federal legislative staffers. Today, I'm going to be talking to you about climate risk, challenges, and opportunities. I am a faculty member down at Florida State University in the risk management program. I'm proud to say that we are the number 3 ranked in risk management and insurance program by U.S. News & World Report. What's more important for today's lecture, however, is I've been interested in this area, climate change, climate risk, natural disasters, insurance, and real estate for over 30 years. If you go back and take a look at my record of research, this is an area that I am highly interested in and have been my entire career. I know for a lot of you, this may be your first introduction to the insurance industry. So I want to take a few minutes and just kind of give you some background. So first, in the United States, the insurance industry today is about a $1.5 trillion industry based on 2022 premium numbers. They employ almost 3 million Americans. Now, there's a lot of retirements coming, so we're hoping to kind of fill that need as we move forward from the educational side. And the final part of this is the insurance industry in the U.S. today contributes more than 3% to the U.S. gross domestic product. When we talk about the insurance industry, a lot of people like to lump everything together. That's very difficult to do. When you look at the insurance industry, there's really 2 or 3 very distinct portions of it. There's the property casualty side, and then there's also the life health side, and a third component of that is employee benefits. What I'm going to be focusing on today is that property casualty side. One of the areas that's most affected by climate risk is the property component in the United States, and that's where I'm going to focus most of my comments today. When we think about the property insurance area, there's actually 2 other distinctions we try to make. Those are on the personal lines for us, the homeowners, the renters, and those that are businesses or the commercial side. When you think about your mom and pop grocery stores, all the way up to your Fortune 500 companies like locations like a Walmart. Again, why do we make that distinction is those 2 areas are regulated very differently. Regulators in the U.S. today are very concerned about how the insurance industry interacts with consumers, the personal line side. And I'm going to talk a lot about that today. I'll give you some resources at the end if you want to talk a little bit more about the commercial property side and how that's affected by climate risk as well. Now, the good news, historically at least in the United States, property insurance, especially homeowners, has been viewed by the insurance industry as a fairly stable, fairly profitable line of business for insurers. Insurance companies kind of knew what losses were going to be. They were able to price that risk accurately, and they were able to make a little money and protect consumers in the United States. Now, when you think about homeowners, I mean, this is an important problem here in the United States. Most people today in the United States, and it's more than 50% of families, cannot afford a surprise $500 loss. They just don't have the resources to do it. Insurance is a component that enables them to purchase a home, a large value item, $300,000, $400,000, $500,000, and pay a relatively small portion, a premium, to offset the risk that the possible large loss, like the entire value of the home if the home burns down. So insurance companies have been doing this for a very long time. They've been very good at providing this type of coverage to consumers. And how it all works, and I'm not going to go into the math behind it, don't worry, there's no math test after this. But insurance companies, what they look for is something called an ideally insurable risk. And what that means is you have a large number of independent exposure units, homes in the United States, cars in the United States. The losses that can occur to those things are accidental, right? They're unintentional. Now, we all know you can always burn a house down or wreck your car on purpose, but that's not most of the time. We're talking about mostly accidental, unintentional losses, and we can predict those types of losses. We have a very good idea based on historical data how often losses can occur. How often do fires occur in homes? How often do they have water damage? Those types of things. What the insurance companies would do with that information is they work with something called the law of large numbers. They would be able to look at an example and say, well, there's a few homes that will have losses, and those losses of the few we can offset by the non-losses of the many. We pull a pool of individuals together, and we'll lump them all together and charge a little bit of premium versus this large possible loss. Those premiums, they're a function of a couple different things. How much could I expect to lose? How good of a driver am I? How risky is my home? The risk charge. How uncertain is the insurance company about the losses that could occur? And then a little bit of profit for the insurance companies. Remember, these are mostly for-profit organizations. They are doing this, although it's a social good, they are doing this to make a little bit of a profit. So as long as it fits the ideally insurable guidelines and we can kind of calculate a reasonable premium, property insurance has always worked in the United States. Hundreds of years this has been going on. And then things changed. So if you're looking, what you're looking at here is a little map, a little chart, and this is early in the morning, August 1992, and that is Hurricane Andrew coming ashore in southern Florida. Hurricane Andrew came ashore as a Cat 5 hurricane. All right? Very few Cat 5 hurricanes have made landfall in the United States. This was a big storm, and for those of you who don't understand how hurricanes work, they are named alphabetically, Andrew being the first named storm of the 1992 season, big storm, all right? So when you look at Hurricane Andrew in 1992, it caused somewhere, depending on the estimates, at the time, somewhere between 16 and $20 billion in losses, $1992 in 1992. Huge loss, all right? So to put that amount in perspective, that amount was greater than every penny that had been collected by every insurance company that sold homeowners in the state of Florida. So every dollar that was collected on homeowners insurance in the state of Florida, you add all of them up, all that revenue over 10 years was erased in one day by Hurricane Andrew. The equivalent today, if you think about Google and you tried to erase the last 10 years of revenue from Google, it's more than $1 trillion. To be able to have that size loss today, we're talking about losses well over $100 billion. So it really changed the way insurance companies thought about catastrophic risk. It was a wake-up call. I started my graduate program in 1993. I went to the Wharton School, University of Pennsylvania. They had a grant from the National Science Foundation because of Hurricane Andrew to study these low probability, high consequence events. It was a game changer in the way insurance companies did things. Second thing it did, even though my slide says it started a new industry, cat modeling had actually begun in the very late 1980s. It was really a jump start to that industry. This idea that insurance companies couldn't look back at historical data because we don't have very good historical data on these types of natural disasters. Instead, what we're going to do is we're going to look forward and we're going to simulate what happens when these types of events happen moving forward. Can we predict what future losses are going to be? And you know, this is very important because if you look at where we are today in the state of the market, cat models are vital to insurance companies. They do two things. They first determine whether or not the insurance company actually wants to insure a piece of property. When you apply, and I'll use the state of Florida as an example, when you apply for insurance, an insurance company actually runs that property through their cat model to see how it changes their underlying book of business. How does it fit with all the other properties they insure? And if it doesn't fit well, they don't offer coverage. So it helps them determine whether they want to insure a property, the availability of coverage, and those cat models also help them figure out how much they should charge. What is the expected loss? What is the uncertainty around it? So cat models today play a vital role in both the availability and the affordability of insurance moving forward. And this is going to be a big issue when we start talking about how climate comes into play here. All right, so what I want you to do is take a step back for 1 second, and I know we're going to be nonpartisan here, talk about climate risk, climate change, and there are some political innuendos to some of those terminologies. So let's just ignore climate risk for a second, and let's just take a step back. Without any change to climate, what do we see? Catastrophic risk causes two major problems. Number one, that idea of an ideally insurable risk. No longer do we have a large number of independent exposure units. Catastrophic risk causes damage to a bunch of those units at the same time in a very narrow geographical area. What that means is those exposure units aren't independent anymore. They're correlated. The losses that occur at one, independent means if there's a loss at my house, it has a zero probability or zero effect on another house. Here, if it's a hurricane and there's a loss at my house, I know the chances of a loss at my neighbor's house are much higher. And that's what we mean by correlated. So we are violating one of those rules of an ideally insurable risk. And the second part is, what does catastrophic risk do to premiums? Well, number one, it raises expected loss, so premiums go up. The second thing it does, it raises the uncertainty. When you think about how catastrophes play out in the United States, some years there's very few catastrophes. Other years there's huge catastrophes. 1992, Hurricane Andrew was an example of a single storm causing a big issue. 2019, when you look at the United States, it wasn't a hurricane, it wasn't an earthquake, it wasn't a flood. They were what they call severe storms, was the largest catastrophic loss. Things like tornadoes and hailstorms, right? Those kinds of storms that happen and pop up, and they happen so frequently in 2019, they were the leading cause from natural disaster risk of losses, right? That uncertainty becomes a huge issue, right? When you think about, I'll use hurricanes again as an example. In 1992, we have $20 billion in losses. Think about Florida, 2004, 2005, 7 named storms made landfall in the state of Florida. One of them was Katrina that caused far more damage in Louisiana than here, but it actually made landfall in Florida. We had a storm named Wilma make landfall. If you remember back, I told you named storms alphabetically. When you have storms that begin with the letter W making landfall, it's been a really bad year for hurricanes. 2004, 2005, $35 billion in damage from hurricanes in the state of Florida. And then 2006, $0. 2007, $0. 2008, $0. All the way to 2015. Then we start seeing a lot more damage. 2016, 17, Hurricane Michael. These storms causing massive amounts of damage, not just in Florida, but actually up into other parts of the country as well. So catastrophic risk caused massive changes to what the insurance industry did. It also causes problems with the underlying fundamentals of insurance. Another problem we have is demographic changes. Since 1992, population in the state of Florida has grown at double the rate of the rest of the United States. People are moving to catastrophic prone areas in the United States, coastal areas prone to flooding around rivers, streams, wildfire areas, mudslide areas, earthquake areas. Pick and choose your natural disaster area. People are moving to those areas, right? People prefer to live near water, and unfortunately, water often means higher risk of natural catastrophes. So what we see is there's more people in the way, right? And that means more insured property damage in the way. So when you look at something like hurricane damage, when you say Florida, well, we have trillions of dollars in coastal property exposure. The only other state that's even close, New York, with southern Manhattan and Long Island having the same magnitude of exposure, the same, the trillions of dollars in value, a lot less frequency. So demographic changes. All of these things add together to change the risk associated with disasters over the last 30 or 40 years. That's even before we consider climate change issues or climate risk issues. So what's changed? How is climate different today? Well, one, talk to the oceanographers and they'll tell you about rising sea levels and that the sea level will rise, and it's going to rise probably 2 to 3 feet by 2100. And that's a done deal. Part of it may be human-made, it may not be. It could be naturally occurring, but sea levels are going to rise. Rising sea temperatures, right? Altered weather patterns. So what does all this mean? What is the net effect in terms of catastrophes on frequency and or severity? And the answer is we don't have a great picture of that yet. We think we may see more severe hurricanes. A hurricane that may have been a Category 1 or a Category 2 could now be a 3, a 4, or a 5. We think we're going to see more frequent tornadoes, right? We think those are the cases. If you look down below on that list I have up there, Why do I list the convective storms second and wildfires third, and then I put floods fourth and mudslides fifth? And this is not a list based on frequency or severity. What this is based on is those top three, they're covered by your basic homeowners insurance policy. 4 and 5, they're not. Those are things that the federal government gets involved with when we start talking about the National Flood Insurance Program, or we start talking about disaster relief that comes in after events. Okay, so climate's changing. Whether it's human-made or not, I'm not going to discuss. But the question is, climate change? Sure, climate's changing. How is it going to affect catastrophe risk going forward is an excellent question. We don't have firm numbers on those things yet. It adds to the uncertainty, which again is going to add to the price of insurance. All right. As an example, what do we mean by changing frequency? So if you look here, if you go back to the 1930s, the 1940s, the 1950s, we actually had an area we used to call Tornado Alley. But if you look over the last 30 years at the frequency of tornadoes making landfall, not hurricane landfall, tornadoes making touchdowns, look at the new area, right? Much broader geographic area where we have frequency of tornadoes, all right? So is it all climate change? Maybe, maybe not. It could be measurement. We may not have been measuring accurately before, but as we can see, we can think about these climate risk challenges as raising new areas of question. So where does that leave us? It leaves us with a very distinct set of challenges moving forward. First, there are challenges to the insurance industry. One of the problems with catastrophes is it violates this idea of an insurable risk, or ideally insurable risk. Catastrophes kind of clump some of this risk together. Number two, it affects the way the insurance industry calculates premiums. CAT models today are the industry standard for how we start to think about catastrophes and how pricing should work. We also have to worry about things that have happened in the United States, demographic changes, as we see more and more people moving into catastrophe-prone areas. Right? The dollar value, the exposure, the property that grows in these areas creates more and more of a problem. Finally, we have to start thinking about the climate and climate risk challenges. How is this going to affect the frequency and severity of natural disasters going forward? When you take all of these together, it's going to have an effect on both personal lines and commercial lines property insurance in the United States. I guess the good news is when we talk about challenges, there's always opportunities. There are a number of people that are interested in what's happening in this field. We on the academic side have been researching catastrophes and how it affects insurance markets going forward. Public policymakers like yourselves are worried about these issues and how it affects voters. We can think about how the insurance industry affects it, industry organizations, regulators, rating agencies. There are a long list of stakeholders that are greatly interested in how these challenges can be addressed. One of the first things, I'm an academic, so what am I going to talk about? A deeper understanding of the challenges. And then the last part is, once we understand the challenges, how do we find solutions to it? If you're looking for more information on this, I can point you to a couple of different sources. If you want to learn more about catastrophes and natural disasters, take a look at the Insurance Information Institute's website. If you want to learn a little bit more about catastrophe models and how science is starting to affect some of the pricing in insurance, visit the National Association of Insurance Commissioners website to take a peek at some of their CAT model information. I spoke mostly in this video about personal lines property insurance, but there's also a whole area of commercial coverages for businesses. Take a look at the riskandinsurance.com article about some of the key challenges facing commercial problems in the market, commercial property problems in the market. I thank you for joining me today. Please visit some of the other videos in this summer series for federal staffers. Thank you.